Hello everyone, my name is Anjani Kumar Khetan. I am based out of Bangalore, and in the last part of our video dealing with accounting for cryptocurrencies by the holder of cryptocurrencies under IFRS and Ind AS, let's continue our deliberation and we will conclude the video series in today's video. So before we continue the deliberation for today, let's quickly look at what conclusions so far we have already drawn in the last two videos. So as I explained to you in the last two videos, that the potential accounting for the holders of cryptocurrencies, we have seen one by one that it is not cash or cash equivalent or a property, plant and equipment or an investment property or E&E asset or a financial asset. Now, this leaves us with two more categories, which is inventories and intangible assets. So this is what we will look at today. Let us first start with inventories and then we will look at intangible assets. So this is something which we'll look at today. Now, whether cryptocurrency can be called as an inventory under Ind AS 2 or IAS 2, let us see this. Now, if you look at paragraph 6 of both Ind AS 2 and IAS 2, it defines inventories as an asset. Inventory is an asset which is held for sale in the ordinary course of business. So for example, your finished goods, which are held by the entity for sale in the ordinary course of business, or which are held, these are the assets which are held by the entity in the process of production for such sale. So for example, work in process, that can be, which are being held, which will be subsequently processed and it will be made the finished goods. Likewise, they are also, inventory is also asset in the form of material or supplies, which is to be consumed subsequently in the production process or in rendering of services. So for example, if this is a manufacturing process which is there, services are to be provided, then consumables, materials, supplies, all of these are something which can potentially be classified and as inventories. So three broad categories under paragraph 6 of Ind AS 2 and IAS 2 is that it is an asset either held for sale in the ordinary course of business or held in the process of production for such, the product or such sale in the ordinary course of business, and which is asset which is being held in the form of material or supplies to be consumed subsequently. Further, you should be able to appreciate that these two standards, they do not say that the inventory must be in physical form. So for example, even intangible form inventory can be classified as inventory under these two standards. So for example, if you have a computer software or any digital asset, that can also potentially be called inventory as long as it is held, let's say, for the sale. So therefore, these standards do not require, these two standards do not require that the inventory must be in physical form. No, it is not. It can be intangible also, as long as the above definition of paragraph 6 is met. As long as these intangibles are also held for these purposes for, let's say, sale in the ordinary course of business, then in that case, they can also be classified as inventory. In practice, if you look at cryptocurrency generally, is not used in any production process. Of course, you are not doing any production process in the strict sense of the term using cryptocurrency. And therefore, in practice, cryptocurrency is generally not used in the production of inventory and hence would not be considered generally as the material and supplies to be consumed in the production process. But wait, also IAS 2 and Ind AS 2, for these two standards to apply, it is necessary for an entity to demonstrate that it's a business model. If you are saying that cryptocurrency is my inventory, if for some reason, if an entity believes and asserts that cryptocurrency is my inventory, then you need to demonstrate that the business model of that entity for holding the cryptocurrency is to sell those cryptocurrency in the ordinary course of business. That means if the entity is able to demonstrate that the business itself of that entity is to hold such cryptocurrencies in the sale of the ordinary course of business. Therefore, if cryptocurrency is being held by an entity for, let's say, long-term investment, say for capital appreciation, or as a hedge against some other investment, obviously it is not held for sale in the ordinary course of business. But in situations where this piece is demonstrated by the entity and the entity is able to demonstrate that the reason why they are holding the cryptocurrency is they are holding it for sale in the ordinary course of business. Now, in those circumstances, if you are able to demonstrate that, then the accounting approach which you may follow in these circumstances only is that in these cases, inventory accounting might be appropriate if the business model of the entity is determined to be holding of the cryptocurrencies for sale in the ordinary course of business. That means in these circumstances, an entity can potentially classify even cryptocurrency as their inventory, provided this condition is met. And if it is classified as inventory, then what should be the basis of valuation? As we know, under Ind AS 2 and IAS 2, inventory is valued at lower of cost or NRV. The same principle will apply in situations where cryptocurrency is determined for this reason to be inventory. Then you will measure such cryptocurrencies as at the lower of cost or NRV. Okay. Now, moving further. Therefore, as we discussed in the last slide, whether the cryptocurrency is held for sale in the ordinary course of business would depend upon specific facts and circumstances. You got to evaluate whether in that particular situation of the entity, when it is asserting that that entity is holding the cryptocurrency for sale in the ordinary course of business, you got to evaluate and see based on the facts and circumstances. Right? So, for example, if cryptocurrencies can potentially be held for sale in the ordinary course of business, for example, a commodity broker or trader. So the nature of business is that you are a broker and trader, and you are saying, I am the broker and trader in the cryptocurrency. Now, if that happens, potentially, yes, you may say that it can be your inventory. Therefore, an entity like, say, for example, the broker trader who actively trades cryptocurrencies. Now, trading means what? Active trading means they expect to sell those cryptocurrencies in near future and they want to make profit out of such active trading, right? Therefore, in these situations, when an entity like the broker or the trader, they are actively doing trading in such cryptocurrencies, they need to really consider whether the guidance in the standard, these standards where we are referring to, the inventory standard, which is Ind AS 2 and IAS 2. There is an exception for measurement which is carved out in these two standards for these commodity brokers and traders. So, if you say that if you are able to determine that I am the commodity broker and trader and the cryptocurrency is my inventory, then also you got to evaluate that whether the exception for measurement which is given, see, general measurement criteria in the inventory standard is, which we saw in the last slide, cost or NRV. However, for commodity brokers and traders, there is an exception, and this measurement model doesn't apply. Rather, you apply fair value less cost to sell. Now, if you determine that Bitcoin or cryptocurrency is your inventory because your business model is to basically trade in those currencies, you being a trader or the broker, then in that case, the measurement basis will not be cost or NRV. Rather, it can be potentially fair value less cost to sell, which is an exception given for commodity traders and brokers under the standard. Therefore, to apply the scope exception for commodity brokers and traders under these two standards, the entity need to demonstrate that first it is a broker trader. They are basically in this business, and the cryptocurrency is being held by them for the purpose of sale in the ordinary course of business. That means they are holding it like an inventory of, let's say, the finished goods, as we have seen, where we saw in the last slide. Therefore, it should also be noted that paragraph 5 says that broker trader, as described in these two standards, right? These broker standards, who are these brokers and traders? That brokers and traders, as I already explained in paragraph 5, it is being given that broker traders are described in the standard are those set of people who buy and sell commodity either for somebody else, like an agent, or on their own account. So they either buy on their own account or for others. Therefore, here there will be a judgment involved in determining whether they are broker and traders because of whether they meet this definition or the guidance given in paragraph 5 of these two standards. So some amount of judgment will be involved. But assume if you have determined based on the specific evaluation of the facts and circumstances that yes, the entity falls in this criteria, in this definition of broker trader, then potentially they will change the measurement methodology of such cryptocurrency held for as an inventory, not at cost or NRV, lower of those two, no, but as fair value through profit and loss account. And that's exactly fair value less cost to sell, the movement going into the P&L account. So, as I mentioned, it is important to recall that for such commodity brokers and traders who acquire and sell cryptocurrencies mainly to generate profit or the broker-trader margin, they have a choice to measure the cryptocurrencies at fair value less cost to sell. Need not basically to go for those cost or NRV. And this fair value less cost to sell measurement basis should be allowed even if active market doesn't exist. For example, again, I'm not going too much into Ind AS 113. There are guidance in Ind AS 113 or IFRS 13 dealing with fair value measurement in situations when the market is not very active or if the market becomes inactive. Let's leave it for the time being. Some other video we will cover that. But what potentially this guidance tells you that in a scenario that if cryptocurrencies are being held by these broker and trader as their inventory, they may potentially apply the measurement exception of not applying the cost or NRV, lower of these two. Rather, they may measure the such cryptocurrencies which they are holding as a broker trader at fair value less cost to sell. Now, also it is important that the commodity, it is that something which has not been defined. The term commodity is not defined in the standard. But a broker trader that has concluded that cryptocurrency is actually a currency. It meets it is like a commodity. If they are able to demonstrate and conclude that cryptocurrency is also a commodity, of course, there is no definition of commodity which is given in the standard. But if they are able to conclude that it is a commodity, then they would measure at fair value less cost to sell. And changes, as the name suggests, in the fair value will go to the profit and loss account. This is the way you have to look at whether inventory accounting applies or not. And therefore, inventory accounting might be appropriate for holders of cryptocurrencies in certain situations, not always. So last slide we saw, if they are saying that cryptocurrency is being held for sale in the ordinary course of business, potentially yes, you can apply. Or if those cryptocurrencies are held by as the broker trader scenario, then in that case also you can apply the inventory accounting. Now here you will not use the cost or NRV, whichever is lower. Rather, your measurement basis will be at fair value less cost to sell, and the changes in fair value being recorded in profit and loss account. Right? This is the way you have to look at can cryptocurrency be classified as cryptocurrency? Yes, but subject to meeting certain conditions. Now we go to the next discussion. This will be the final classification basis, that can you call cryptocurrency as an intangible asset? Let's see, first of all, what intangible asset is, what are its characteristics. under Ind AS and IFRS, and then we will test it again, just like any other cases which we saw earlier, that whether cryptocurrency falls within the definition of intangible asset. So if you look at the definition of intangible asset in paragraph 8 of both these standards, Ind AS 38 and IAS 38, this paragraph 8 tells you that intangible asset is a identifiable non-monetary asset without physical substance. So the three key attributes of an intangible asset as given in paragraph 8 is that it is an identifiable asset, which is a non-monetary asset without physical substance. And when we say asset, what is the meaning of asset? Now, asset in the conceptual framework, asset is defined as a resource controlled by the entity as a result of past events from which future economic benefits are expected to flow to the entity. So if you read paragraph 8 along with the definition of asset, you will read it like this, that an intangible asset is an identifiable non-monetary asset which is a resource held by the entity, resource controlled by the entity as a result of past event, and from such intangible asset, the entity is expected to have future economic benefit. And those, of course, has to be without physical substance, and that's why they are intangible. Right? So this is the way definition of intangible asset is. Now let us slightly go deeper into these, because these terms like identifiability, non-monetary, and then asset, physical substance have much more nuances. So let us quickly look at paragraph 12 of these two standards. It explains what do you mean by identifiability. So it says identifiability criteria as contemplated under these two standards is accomplished. That means you will say that the intangible asset is identifiable if that intangible asset is either separable or result from contractual or some other legal rights. So for example, let us say you are an entity A Limited. You acquire any entity B Limited in a business combination. You acquire the business of this B Limited in a business combination, and you then also acquired the, let us say, an intangible, which is, let's say, the copyright or the trademark. Now, that in the books of A Limited, that copyright or the copyright or the trademark, that is resulting from the contractual or legal rights, because the acquisition of that particular intangible asset happened on account of the business combination. Likewise, if that intangible is separable, keep in mind, the word separable from others means capable of being sold, transferred, licensed, rented, or exchanged separately. The word used is capable. You may or may not want to sell it, but as long as the asset is something which is amenable to be sold separately, then that may meet this test. So therefore, when we say identifiable basically means either separable or arising from contractual or some legal right. Now, since cryptocurrency can be freely transferred, we have seen that, can be freely transferred to a willing buyer, it is generally considered to be separable because you are able to transfer and sell. Okay. Similarly, cryptocurrency result from contractual rights. Okay, if those cryptocurrencies result from your contractual rights and obligations, then of course this will be considered as identifiable. Now, what about non-monetary? Now, non-monetary is again explained in an indirect way in paragraph 8 of these two standards. Rather than defining non-monetary, they are defining what is monetary. So in paragraph 8, monetary assets are defined as money held, that is the cash which you have, or assets to be received in fixed or determinable amount of money. So for example, if you have a dollar receivable of 100 or a payable of, let's say, pound 500. Now, in rupee terms, what you will get may be dependent upon the exchange rate, which is applicable on conversion. But purely if you look at these receivable and payable, whatever may be the exchange rate, tomorrow, but what you have the right, you only receive $100 or you will pay only 500 your pound. So they are settled in fixed and determinable amount of money, which in my example was $100 and pound 500. This is a fixed number. The rupee equivalent might be different, and therefore that is the way the monetary items are defined. So non-monetary, by default, it will be in the other way around. That means something which is not fixed. So therefore, if you read here the last 2 points, what we are saying, non-monetary items obviously will not give right to receive or the obligation to deliver a fixed or determinable amount of currency. This is which is just converse of this. So if you are not giving an exact amount of 500 or 100 currency unit in the respective case, then it becomes non-monetary. Right? Now, so we have seen identifiability, we have seen non-monetary. What is asset? I've already told you. Asset is defined in the conceptual framework, which we have seen here. Right? Now, when we say here, if you see in the, 1 minute, let me clear this. Yeah. So if you see here, the definition of asset is what? A resource which is controlled by an entity. What do you mean by control? So control test is for the control test to be met for an asset. Control test is met. This is the guidance given in the standard where both these standard where it says control test is met if the entity has the power to obtain the economic benefits that the asset will generate and also the power to restrict the access of others to those benefits. What does it mean? It simply means one thing. So I have an intangible asset. Control means I have the right to enjoy all the benefits out of this. And I have the right to deny the benefit to somebody else. This is the second layer. And to restrict the access of others to those benefits. So control test is met in these circumstances. Right? Now what about the future economic benefits? Cryptocurrencies, as we have seen, do not provide contractual rights. We have already seen that. However, economic benefits are likely to result from the cryptocurrencies when you are, let us say, potentially selling them to a willing buyer. So if you sell them, then you will get, just like what we talked about the gold and the bullion. Right? So that will give you the future economic benefit. Right? Likewise, without physical substance, that means intangibles have no physical form. And since cryptocurrency is the digital representation, which we saw in the first video, by nature, therefore, it is devoid of physical substance. And the cryptocurrency has no physical attribute, and therefore, it will be within the scope of these two standards, Ind AS 38 and IAS 38. Unless you fall into inventory, which we saw in the previous slide. So, unless it is being held for sale. If that intangible is being held for sale, based on the actual evaluation of facts and conditions being met, which we already discussed, then it will go into inventory standard. Otherwise, you can say that cryptocurrencies fall within the scope of the intangible standard Ind AS 38 and IAS 38. So bringing it further, what we have seen, the definition, these are the key attributes. These are the key attributes of an intangible asset. That they are identifiable, non-monetary asset without physical substance. And therefore, if you also look at the basis for conclusion number 5 under IFRS framework. So under IFRS, the standard IAS 38, if you look at basis for conclusion 5, it tells you then if an item has these characteristics as given in paragraph 8, an item with these characteristics is classified as intangible asset irrespective of the reason why an entity holds that asset. So they are intangible. But whether you will apply IAS 2 or Ind AS 2, or you will apply IAS 38 or Ind AS 38 is dependent upon whether you can meet the conditions for inventory. If you meet the conditions for inventory, which we saw in the earlier few slides, then Though it's an intangible, it will be accounted under inventory standard. There you will apply the measurement criteria of what? Cost or an RV. But for broker trader, you will apply fair value through fair value less cost to sell. But if you are in the Ind AS 38 or IAS 38, then intangible assets are measured at cost or revaluation method. So the basis of methodology will be different. Now, as you might also recollect that under the intangible standard, revaluation model can be applied only to such intangible assets which have active market. Now, in case of cryptocurrency, clearly they are traded, and therefore the market criteria will also be likely to met. And therefore, potentially cryptocurrencies, if you are classifying them as intangibles under Ind AS 38 or IAS 38, you may apply either the cost model or the revaluation model, because active market condition, which is otherwise contemplated under this standard, will also be met. Right? That's how you have to understand the accounting for cryptocurrencies. Right? So therefore, Ind AS 38, and this, as I've told, applies to all intangible assets, except those which are outside the scope, like inventories, which we saw. And therefore, even cryptocurrencies will also be within the scope of this standard, Ind AS 38 or IAS 38. Right? That's the way you have to conclude. Therefore, if you look at, although cryptocurrency generally meet the wide definition of intangible assets because they are intangible, identifiable, lack physical substance, they are controlled by the holder and gives rise to future economic benefit to the holder when they are selling or transferring these to someone else. So, what is the net outcome? We have covered this in 3. This is the 3rd video of the series. So now let us conclude what is the final outcome. So the final outcome is, this is the chart where we started our deliberation, and we have seen that yes, cash equivalent, PP&E, intangible asset, E&E assets, and financial asset, no. Inventories, yes, but then only in limited circumstances. So a cryptocurrency can potentially be accounted for and applied, and you can apply the inventory standard. Inventory accounting may be applicable, may be appropriate in certain situations if the business model is demonstrated to be holding those cryptocurrencies for sale in the ordinary course of business, either regularly or as a broker trader. Now, if in either way, your measurement basis may change. When it comes to intangibles, yes, as we saw in the last slide, yes, the test of intangible asset definition is being met by cryptocurrency, and therefore they are to be classified as as the intangible assets. So that's what I wanted to cover for this particular video. Like in the earlier sessions, this is the gist of some of those videos which are there. This is the link of my YouTube channel, and this is the QR code for some of those important videos on various areas which are there. And then please remain connected. Do subscribe to my channel and remain connected both on the YouTube and on my LinkedIn page. So this is what I wanted to cover for this particular video, and I take a pause in today's video, and I will connect with you in separate video at a later point in time. Thank you. Bye for now.